So I put this in here. You see this file here?
Yeah.
Cost of goods manufactured.
Mm-hmm.
This is going to be like a chapter 15 kind of demonstration. I'm going to show you how to put together the cost of goods manufactured and then how it connects to the income statement.
Alright.
Yeah, so if you want to pull that up at some point, you can always go to this file, and then when I'm done showing this, I'll put this presentation up there where you can go back and review it if you want to. So we got the, I'm going to use Excel to do it. I like Excel.
Oh, it's pretty good.
Yeah, it does the math for you, yeah? And then we can open that guy up. So I got my, that's my PDF with the data on the left. And this comes from an old midterm that I had back in 2012. So still a good problem. Okay.
Mm-hmm.
So in a manufacturing company, we prepare this cost of goods manufactured schedule because we're not necessarily, you're kind of moving away from the mindset that you're buying stuff and then reselling it. Now you're actually making the stuff and selling it.
Okay.
Yeah. So we're gonna have, we've got 3 inventory accounts, and the inventory accounts are based on what stage the product is at in production. So you got raw material, so that hasn't even been worked on yet. Then you have work in process or work in progress, and that's stuff that has been worked on but it's not finished. And then you have finished goods. So those are the 3 inventory accounts. Okay, and you can see them listed here. There's the raw materials, there's the work in process, and the finished goods. Okay, so it makes use of the periodic method in each of those categories. So what we do is, this company's name is called Kaneohe Dark Chocolate. So I would probably head it up with the company's name. Let's see, I'm not spelling chocolate right. Okay. Make it a little bigger so everybody can see that. And we'll call it cost of goods manufactured schedule. Okay. It's not a financial statement, it's an internal document, but we'll set it up like a financial statement. And then we'll say for the year ended December 31st, 2012. Okay. So you always start with the beginning work in process account, right? And that's this. You know it's the beginning because it's from January 1st, 2012. I don't know if we can just copy the text over. That might. Hey, okay. So we got the work in process on January 1st, 2012, and that's $125,000. Okay. And then we're gonna, inside of that, we gotta determine how much direct material was used. Okay, so when we talk about direct material, that's stuff that's directly traceable to the product. So like we're looking at these computer screens. Say we were in a manufacturing company where we're building computer screens.
Mm-hmm.
We know exactly how much plastic, how much metal goes into each unit. So we can make a direct relationship with each unit. We can say, well, we're using half a pound of plastic, right, for each monitor that we're making, each computer screen we're making. Okay. Whereas an indirect material might be something that we don't necessarily know exactly how much is going to go into each product, right? So, you know, there might be some type of lubricant that some of them don't fit correctly, so they need a little more lubricant, right? So that kind of stuff, that might not be the best example, but just anything that's not direct would be indirect. That's the way we kind of make that determination. So if we can trace something directly, then it would be direct material, and that's the same for labor, right? If you got an hourly individual, then you kind of know how much time they're spending on each monitor that they're making. So you have a direct relationship. You can say that it takes a quarter hour to put each monitor together with that labor. So you can make a direct connection to that. And you can translate that into dollars. Whereas the plant manager's salary would be indirect. Yeah, because the plant manager might be overseeing monitors, overseeing outlets. There might be various things going on, and he or she could be spending different amounts of times in different areas, and it might not be consistent. It might not be the same amount of time each time they're out there or on each work shift. Okay, so I'm going to start with the raw material inside of here. I kind of indented it. We'll take the beginning raw material. So the raw material inventory on January 1st, 2012, and that's going to be 340,000. Okay, and then what we're going to add is any purchases of raw material. So this is starting to look pretty similar to the periodic method when we were just buying and reselling stuff in the retail situation. So we're going to add any additions. So let's see. Do I have purchases of raw material? Here, raw materials purchases. Okay. So we'll call that. Actually, we can probably copy that too. You don't have to retype it. Okay. And that was 450,000. Okay. So that when those two are subtotaled, it's going to be called cost of raw material available for use or for production. Okay. I'll just put use in there. Let's see. And then we'll widen this a little so it fits. So that's actually adding these two together. So you got 790, and then just like when we did the retail, we're going to subtract the ending inventory amount. So in this case, the ending raw materials inventory. So that would be the 12/31 or December 31st, 2012. Yes, and then I'll just put the word less in there so we know that we're subtracting. I need to make a little more space. So to stress it, I would maybe show it as negative, but this word less here is indicating that we're going to subtract, so we can leave it that way. And we can say that this was our direct material used. Okay, so when I'll put it right here and subtract that. Okay, that's our direct material used. Okay. Now we gotta pick up the direct labor, because the three manufacturing costs are direct material, direct labor, and a thing called overhead, manufacturing overhead. So manufacturing overhead includes all of the indirect material and indirect labor. So just because it's called indirect doesn't mean that it's not part of the product. It's still part of the product. We just cannot make a direct unit for unit relationship. Okay. So it's not like general and administrative costs, which are not even tied to the product. Indirect costs are still part of the product. It's just because we can't make that direct relationship, or it's not really worth our time and effort to go through the process of making the relationship. So it gets lumped into indirect. Okay. So the next thing we got here is going to be called, I'm going to indent it, direct labor. That's an easy one. We'll just pick it up over here. 375, 642. Okay. So that's manufacturing cost 1 and manufacturing cost 2. Well, we can't put that label there, but okay. And then the third category that I was mentioning is manufacturing overhead. And now with that one, we got to go in and find all of them. So we kind of go down the list. Of course, we're not going to take the inventory accounts because they're on the balance sheet and then they don't pertain to overhead. We use the raw material and the work in process to get the direct costs. Okay. Of course, anything indirect, like I said. So indirect labor will be one of them. And I pulled that right over here, 375, 642. What else do we have? Accounts receivable wouldn't be because that's an asset on the balance sheet. That's not a cost. So we're going to leave that guy alone. Anything that deals with the factory is somehow part of the yeah, it's going to be an indirect, but it's somehow part of making that thing we're manufacturing. So in this case it's chocolate. So all three of those I would put into the manufacturing overhead category because they're part of the cost of the product. It's just that we don't have a direct traceable relationship that way.
Technology for the chocolate or whatever.
Yeah. So got okay, and so I'm going to capture all three of those in my manufacturing overhead. Wait, I skipped over one. Factory insurance, factory machinery depreciation, and factory utilities. Now, in this problem, they didn't tag office utilities with the word factory. So, in this academic exercise, I'm going to keep that out of my overhead. That's probably something like the accounting office or the marketing department. It's not part of making the product. So, we're going to call that general and administrative expenses, not overhead, okay? Sales is your revenue figure, so that has nothing to do with costs. And sales discounts are a contra revenue account. So that's on your income statement in the revenue area, not in your cost area. Plant manager's salary, I would put that one in there. Plant and factory are synonymous. That's probably one of the best examples of an indirect cost because the manager is probably not out on the manufacturing line working on units.
Yeah, he's keeping the plant like together.
Right, overseeing things, right?
Yeah.
Managers overseeing things. So it's really hard to identify how much time he or she is spending on each specific unit. Whereas your labor, hourly workers, you can track that. You can say, well, they spent 4 hours today working on computer screens and another 4 hours working on mouse pads. You know, make something up like that, right? So you can directly tie the cost of their labor to each unit that your company's making. Okay. We actually should be talking about chocolate, but I threw in computer screens. So that's going to be 85,000. And then the next two they're clearly part of the factory cost, so we'll put those into factory property taxes and factory repairs. Can actually go a little smaller, squeeze it in, okay? So the property taxes are 9,845 and the repairs are 56,000. Just coming from this data over here. Okay. So I'll call that total manufacturing overhead. and we'll tally up that amount. And see, I'm keeping it in line with my other two manufacturing costs. So these two guys in bold here, I'll keep it right in line. Okay. So we got our three manufacturing costs, and we can sum those up and call them the total of those. If I add the three of them, we'll call it total manufacturing cost. Okay. All right, and then notice we did a periodic type method here to get to the direct material used. Now we're doing another periodic method out here. So we're going to have a subtotal here, and then we're going to subtract the ending work in process. So out here, broader in the gray area, we'll have another periodic method going on. Okay. And when I add my beginning work in process with my total manufacturing costs, I'll have what we call total cost of work in process. Okay. And then what we do now is we're just going to subtract the ending work in process inventory. So that's the work in process inventory from 12/31/2012. Will it let me stick it in there? Okay. So when I subtract that, 634,212, okay, that will take me down to my, this is what we're trying to get to, right? Cost of goods manufactured. Okay. So I'll just take this guy, subtract. And that's the purpose of this schedule, is to get to the cost of goods manufactured. Now, why don't we go a little smaller? Where does that go, right? Why are we doing it? Do we just want to know our cost of goods manufactured? Well, we're going to funnel that number up into our income statement. So in this exercise, we're not given information to do a full, well, we have enough to do a full income statement, but it's not really a big income statement. You know, there's few expenses because they want you to focus on how this cost of goods manufactured makes its way into the income statement. So out here on the right, I'm going to do an income statement. We're going to call it income statement, right? And we don't have to change much more in the title. So side by side here, we have the income statement. And remember, with the income statement, we start with sales, right? We start with the revenue figure. So I'm going to have sales here. Why don't I put a box around this just to make sure we know that it's separate from what I'm doing now. Okay, that's a separate document that's in gray there. Okay. Now for my income statement, we'll start with sales. And we have sales of, you got to look over here, right? 4,653,120. Okay. And remember that sales discount account is a contra revenue account. So we're going to say less sales discounts. Okay. So I'll subtract that. 347,616 right over here, right under sales. And then we'll have a figure that we call net. We don't need to indent. Net sales. Okay, so the difference between your sales revenue and your sales discounts. That's your net sales. And we know that from Accounting 201, okay? Now, what we need to do is subtract our cost of goods sold, but we got to figure that out. So this cost of goods sold figure could either be, figured out or computed on a separate document if you wanted to, or you could put your cost of goods sold schedule right into your income statement like I'm gonna do. Okay, so remember in the periodic method we're always gonna start with the beginning inventory. In this case it's gonna be the beginning finished goods. Remember we got 3 inventory accounts. We've already utilized 2 of them, the raw materials and the work in process. We've utilized them to figure out certain things and ultimately get to cost of goods manufactured. So now we're going to use that final inventory account called finished goods. So we're going to start with the beginning finished goods inventory, and let's make sure we can make it fit. Okay, so we'll inch this guy over and go a little bigger. We'll stretch these out. Okay. So in this case, the beginning finished goods inventory is 509,874. Now this is where it comes into play. We are going to add the cost of goods manufactured. Okay. Right? And if we remember, we just figured that out on the cost of goods manufactured schedule. So that number is going to come right in here. I'll make an arrow. We're going to take that number and put it right up in here. Okay. So that number flows over from the cost of goods manufactured schedule. Okay. Right. And then from that point it's really similar to a retail, right? Retail cost of goods sold schedule. We'll have cost of goods available for sale when we add these two. That one and that one. And then we're going to subtract less our ending finished goods inventory. I'll paste that in there. I'll make it a little wider again. Okay. So that's 949,354. Okay. And that will give us our cost of goods sold when we subtract that. And I'll line it up with my net sales. Because what I need to do now is I need to subtract my cost of goods sold from my net sales. So we don't have a little thing saying less or indicating that. So what I might do is I might go ahead and make that cost of goods sold figure, I'll make it negative. So same number, just turn it into a negative. Let's double check that real quick. Yeah. Okay. And if we were doing this, it would be in parentheses. So we might want to make it in that format. We'll go back and do that on the cost of goods manufactured schedule. Okay, so when I subtract my cost of goods sold from my net sales, you remember what we end up with? I'll give you a hint. Gross
profit?
Yes, gross profit. Okay. So always remember, right? Sales minus cost of goods sold is gross profit.
Yeah.
Yeah. And then we'll have the other expenses. So in this case, if we scan down real quickly, of course, this is a real short problem, and they want us focused on this area, right, and the cost of goods manufactured schedule. So they're not spending a lot of time with the other expenses, but remember, you could have a full income statement with all of the other expenses. Let's see. We only have, we've used all of the factory and the indirect stuff. We got office utilities, and That's it. So you'd have this other category, general and administrative expenses. And in this case, we only have one, so we'll say office utilities expense. And then we can say total squeeze that in. So our office utilities is 155, and when we subtract that from our gross profit, we will have our net income. So net income so just review a little bit. Why don't we make these look similar? Oops, too many zeros. So we flow everything down through the cost of goods manufactured schedule, come up with our cost of goods manufactured, and that's going to work its way over to our income statement in the section where we determine what cost of goods sold is. Okay, it's flowing right up into here. You know, if that was a retail operation, you would have they might call it merchandise inventory, right? Beginning, I'm going to abbreviate, but beginning merchandise inventory, and then you would have added purchases. Then you would have the same cost of goods available for sale. Then you would subtract the ending merchandise inventory, and that would give you your cost of goods sold. Right? It's basically the same formula, it's just that in a retail outlet, we go out and we just purchase the items. See where I have this thing highlighted in yellow? Whereas in a manufacturing operation, we're making it, so we're pulling that, the equivalent of what the purchases would have been in retail, we're pulling this thing called cost of goods manufactured from our computation of that, which comes off of the cost of goods manufactured schedule. Okay. I'm kind of explaining it and re-explaining it, but it's not difficult, but there's a lot of moving parts. So you just have to pay attention when you're working on it. Look for the right numbers. Now they want us to do the partial balance sheet. They don't give us all of the liabilities. They don't give us all of the equity stuff. And they give us a couple of assets. So we'll make the balance sheet. Now remember, balance sheets are dated as of a specific date. They're not for a time frame. So we can say as of December 31st. And then you're going to have your assets section. And I'm looking down at what we have, the data available, and there's nothing that shows liabilities or equity. So we're really doing what we call a partial balance sheet. We're just showing assets only, current assets. Okay, so we have, and we'll just put them in as assets. So we're going to have do we have cash? Yeah, we have cash. So we're going to put in that cash amount right from the data, 135, 467. Got it right over here. Now what other assets do we have? Scan down. We have all of these inventory accounts, but I'm going to take care of that one after accounts receivable. So I'm going to put, remember, order of liquidity. So we got accounts receivable. And that's right over here, 786,234. Okay. Now we have inventory, right? And check it out. We got three inventory accounts. We have raw material, finished goods, and work in process. And remember, we're going to start in order of liquidity. So the finished goods inventory would probably be the one that we could liquidate the quickest because it's ready to be sold. Somebody might make an argument that the raw material has a resale market somewhere, but really, if we're thinking about the cycle of how our business plays out, the finished goods is the thing that's going to convert to cash quicker than the raw materials are the work in process. So I'm going to list my ending finished goods inventory first. That would be from December 31st, 2012. We'll go 949354. And then the next inventory account that would be liquidated would be work in process, because those things are partially finished, right? They're closer to being sold than raw material, okay? So, and we don't have to put the date on the balance sheet because it's already assumed as of December 31st. And remember, those ending balances are what go on the balance sheet. So on December 31st over here, I got 634,212. And then I'm gonna have the raw material. So finally, raw material, and that's $322,500. So $322,500. Okay. So you could either add it on another line or just subtotal it. So I'm adding the three inventory accounts up. Okay. And basically, that's going to be our total assets, right? Total assets. When we add up our cash, accounts receivable, and our total inventory. Might make it a double underline. So you would have to use your knowledge from Accounting 201 from preparing financial statements if you had more, right, more liability, more equity items. You would need to know how to categorize it. But the focus of this chapter is learning how to do this cost of goods manufactured schedule, which we did over here. So that's the way it works out. Also make note, we use the ending balances in these inventory accounts to figure out cost of goods manufactured and to figure out cost of goods sold. So those guys in yellow are being used over here just to get to those costs, right? We're using them to get to the direct material used. We're using them to get to cost of goods manufactured. We're backing into that number, and we're using them to get to cost of goods sold. Okay. But those balances are actually reported over here on the balance sheet. Okay. That's where they actually are showing on an actual financial statement. Let's see.